the investment world can appear complex to some people, which isn't great when it comes to retirement planning. For inexperienced investors or those not having the time to manage their cash, the recent stock market fall can make the task appear even more daunting. If this is the case, then a target date fund could be just what you're looking for. Hello, I'm Dunne, AJ Bell's Head of Research. Welcome to the latest edition of Breaking the Mould, our regular look at the financial markets. Now, the FTSE 100, that's the index of the largest companies trading on the London Stock Exchange by market cap, has fallen by more than 15% since the 27th of April. On Monday the 24th of August alone, more than £73 billion has wiped off the value of companies in the FTSE 100. Fears of a slowdown in China, the world's second largest economy, have forced not just London but stock exchanges around the world lower as investors move their cash out of equities. Now, how worried you should be by the market's recent performance depends on your age. If you have a pension, there is a good chance that your money is invested in the FTSE 100. The huge losses racked up by the stock markets are an issue if you plan to retire anytime soon, because the likelihood is that the size of your pension fund has shrunk. So, those approaching retirement should be much more concerned than, say, someone in their 30s. It could mean that they may have to postpone their retirement or settle for a smaller pension to fund their twilight years. This shows just how important it is for investors to have a plan, one that helps them to benefit from the potential gains that the stock market can offer while reducing the risk of losses the closer to the retirement they get. Target date funds are products that have been designed to do just that. Also known as life cycle or age-based funds, they automatically alter the weighting of stocks, bonds and other assets in its portfolio according to a set time frame. It gradually reduces volatility as a target maturity date approaches, which is usually on or around an investor's retirement age. So they are funds that manage risk to reflect a saver's remaining investment time horizon. This is the investment equivalent of flying an aeroplane on autopilot. It's a low maintenance retirement plan where assets are bought and sold for you and managed to reduce the risk the closer the fund gets to your planned retirement date. A saver's only input is deciding how much they invest and the year they want to start withdrawing their cash. So you put your money in, decide when you want to take it and any gains it has made back, and then forget about it until retirement arrives. Now, this is how it works in more detail. If an investor is decades away from retiring, they can expect equities to feature heavily in their target date fund, but the closer it gets to your retirement, the more conservative it becomes, so the lower risk it carries, such as buying more bonds than equities. The strategy changes from growth to protection, you see. This is proving to be a popular way to prepare for retirement. In the US, more than $700 billion was invested in target date funds at the end of 2014, according to Morningstar. In the UK, they are also used for workplace pension investing, such as Nest, that's the government-established workplace pension scheme. These funds are managed by a professional who alters the risk-return balance as applicable. Decisions are made based on the time horizon of a saver's goal and changing market conditions, but be aware this does not mean that the returns are guaranteed. You still run the risk of collecting less than hoped for your retirement date, or worse still, losing your money. So, as with all investments, do your homework. Look at the funds on offer, look at the track record of its investment manager. Also look at the fees. There could be a regular management charge or an entry fee. And also ask if there's a fee for cashing in early. You never know, you might need it. Thank you for your time, and I'll see you next week.